Welcome to today's video. My name is Madelon Vos and this is Madelon Talks. Today we'll discuss the most important macroeconomic and crypto related news of the week. And this week's video is all about the inflation rates. Last week the Bureau of Labor Statistics published an article about the inflation rate of June, and this combined with the inflation rate of the last 12 months is way higher than expected and is quite disturbing as well. So we're going to take a look at what's happening right now and what to expect in the future. And we're also taking into account the macroeconomic circumstances we are in right now. And to be honest, it doesn't really look good. But we're also going to take a look at Bitcoin and the cryptocurrency market, taking a look at what's going to happen next. We're quite in a market that's not really outgoing and there's not happening a lot. So we're going to dive deeper into the latest news, taking a look at the stock to flow model and see if it's really accurate still. And in the end of this video, we're going to take a look at the chart of Bitcoin and see what we can do with technical analysis as well. So for now, I'm going to put myself in the right corner of this video. And if you aren't subscribed to this channel yet, make sure to do so by clicking on the red button down below. I know 60% of you guys who are watching aren't subscribed to the channel, so make sure to do so. Also make sure to click on the bell so you get notified when there's a new video online. Okay, we're going to start with the economic news release from the Bureau of Labor Statistics, and this is the release, the summary they've made about the new inflation rates. And before we're going to dive deeper into this press release, we must know what this press release is all about. It's about inflation rates. And this is very important because inflation measures your purchasing power. And as you might know, your purchasing power is decreasing over the years. When it comes to central banks, they have a mandate of price stability. So they're trying to have stable prices and making sure that consumer goods and services aren't increasing too fast in prices, but also make sure that they aren't decreasing when it comes to the prices. Why are they doing this? When they are looking at their economic theory, this theory says that if we as consumers know that prices will increase 2% a year, then we are going to spend earlier. Then we are not going to put money in the bank. We're just going to spend it anyways. And you can agree on this theory. I won't agree with you, but some people agree on this theory that we are likely to spend more when we have more inflation. But in my honest opinion, money will end up elsewhere and we're creating bubbles everywhere. And that's what we are seeing right now. But to make it really clear, the central bank has a mandate of 2% price stability, so an increase of prices at 2% a year. And if we overshoot this means that our money is decreasing in value very, very fast. And this press release is all about the increases in prices when it comes to the CPI, the Consumer Price Index. And let's take a look at the increase of June. They released this on the 13th of July, and these are the numbers of June. And when it comes to the seasonally adjusted percentages of June, we're sitting at a 0.9%. And when it comes to May, we are sitting at a 0.6%. And this is not even the worst, but if we take a look at the last 12 months, so the increase of the inflation, or at least the decrease in money, the value of our money, we're sitting at an increase of 5.4% before seasonally adjusted, and this is the highest increase since 2008. So since 2008, we haven't seen an inflation rate that's this high over the last 12 months. And this is very disturbing because when we hear economics talk about this subject, or for example, we spoke about Lynette Zhang and Daniele Cambone doing an interview together, and Lynette Zhang said the central bank has a mandate, but they don't have any tools yet to make sure that they can put down these inflation rates. So what might happen is that the inflation is going to overshoot the 2% target for quite a long time. And this means that people are getting poor slowly or poor less slowlier than when it comes to the mandate. They are losing their purchasing power really faster than expected. And this is where it becomes quite scary, because what are the central banks going to do? And there are some tactics that they can do, but for now, there is one big question. I will come to the tactics when we are discussing this later on in the video, but for now, there's one big question, and the biggest one is inflation really transitory? Because after this press release, after we knew these figures, Jerome Powell made a statement, and in his statement he said that he still believed that inflation will be transitory and that we will see lower inflation. But if we look at what economists are saying right now, then they're saying that inflation shit could hit the fan. Let's say it like this. Inflation being here to stay as PPG preparing for more price hikes. So they are expecting that inflation will rise higher. And this is going to get really worse. One of these economists said, "I'm not seeing this as transitory. The work from home phenomenon is going to lead to additional wage inflation because people are going to have opportunities to figure out where they want to work." And this is completely correct, because we have seen that people didn't want to work in a restaurant or didn't want to work at a shoe shop or something like that, or a supermarket, because they can work from home as well, but also because the salary is way too low for the rent that they have to pay. So this is where it becomes a systematical risk. This is where it becomes systematical, because the problem is coming from inside. The problem is coming from the fact that the prices are increasing so fast that the wages have to increase as well. And when wages increase, you will get it the other way around as well, because when wages increase, there is more money to offer in the supermarket, more people have more money, and then the prices will rise as well, maybe even faster than when money is created out of thin air. So this is where it becomes really important and really harsh. Of course, I made a joke on Twitter, but this is what it's all about. People don't get what's going on. They said I have had a raise of 3%, but inflation is 5.4% over the last 12 months. So they don't know that the value of your money is increasing. And it's so important to know what's going on. And if you know that this is happening, you will look around for other ways to make sure that your money is at least safe for devaluing. And what are the safe spots? We have seen that a lot of investors went to the stock market, went to Bitcoin, went to gold and silver, went to even bonds. Even when you know that you will get a negative return on a bond, people are still investing in bonds because you will have less inflation, even though the real rates will be like way lower, but still. And then you will have, of course, the housing market as well. We've had a lot of investors that were like not even big firms, or it were just normal citizens just like you and me, but they started to invest. And I'm not sure if they are getting what's going on right now, but at least some of you are getting what's going on. And I think it's really important to know what's going on and to know what your options are. So here in the Wall Street Journal, I found this article, and this is about higher inflation is here to stay for years. So these economists expect that due to this pandemic, there will be more inflation, and at least until 2023. And there are some ways to get around when it comes to this inflation and to get back to normal, but these scenarios are not the best scenarios. These are completely disrupting economies and completely disrupting families, companies, and countries as well. So what I wanted to tell you is that I have been talking about inflation for years. I've been talking about this on my Dutch channel, which I started like 3 years ago, but I've been writing as a columnist as well about inflation, about housing pricing bubbles, and to be honest, this have been something that we could see coming. And right now, Jerome Powell is saying this is transitory, but in my honest opinion, it's probably not transitory. Even though they can change the figures, they can't change the prices of the end product. So take a look at what's going on in the supermarket and see it with your own eyes. So when it comes to the things that we can do or cannot do, we must take a look at history, because in history there have been scenarios that look quite the same as we are seeing right now. And I have been telling you this since January or so. And in January we spoke about the fact that this looked like a stagflation scenario. And a stagflation scenario is a scenario. For example, I will show it to you. Following Investopedia, this is what stagflation is look like. Stagflation refers to an economy that is experiencing a simultaneous increase in inflation. That's what we're seeing right now. And stagflation of economic output. So the GDP is decreasing, and what we're seeing right now, or what we're seeing as well during this economic decrease or stagnation, we're seeing that unemployment is high, or at least higher than usual when it comes to inflation, because usually inflation comes at a time of economic growth, of high conjuncture. And then we have those measures from the central bank to increase interest rates, for example. And when the interest rates are going up, then the conjuncture, the chart will go down again. And then we will go into like a normal economic vibe. And right now, we are seeing that these measures are doing the opposite. So we are in a scenario, in my opinion, we're in a scenario which is the worst that you can be in, because if we are now increasing the interest rates, the debt is way too high to pay off, and the deficit will be way higher as well. The deficit is way too high to pay off debt. We need to have inflation to make the risk of debt lower, or at least the weight of the debt lower, but that's impossible, because then companies, countries, citizens will default. So we are in a scenario which is very heavy, very heavy. So stagflation refers to an economy that's experiencing a simultaneous increase in inflation, what we are seeing right now, and a stagnation in economic output, what we're seeing as well. Stagflation was first recognized during the 1970s, and I've told you this before, where many developed economies experience rapid inflation and high unemployment as a result of oil shock. So rapid inflation and high unemployment. We are seeing high unemployment as well, because people can stay from home, work from home, and they don't want to work in a supermarket or in a restaurant because the wages are way too low. And they have like money from the government and all those programs that they can get money out of. And then we come to the next one. Prevailing economic theory at that time could not easily explain how stagflation could occur. And this is where it becomes very interesting, because Investopia changed the page. When I was reading this page, I think it was a month ago, they said that stagflation could occur by printing a lot of money and bad government regulations. And to be honest, in my honest opinion, there has been printed way too much money. Only in 2020, there has been printed like 21% of the total money supply. And the regulation is quite bad, because we have had to deal with a pandemic, or at least we have had lockdowns. And this is quite heavy for an economy. So it is true that something like in the 1970s could happen again due to bad government regulations and a lot of money printing. And that's what it said before, but right now it's not saying it anymore. So that's quite strange, but okay. There is something else that I wanted to say, and that's the wage push inflation. That's where inflation becomes a systemical risk, and this is what we're seeing right now. And when we have this wage push inflation, this happens when the wages need to rise because otherwise people won't work anymore. And this has something to do with stagflation as well, but we are not going to dive deeper into that. We're going to take a look at an article from Nouriel Roubini, and to be honest, I'm not really a fan of Roubini, but when it comes to economic theories, he's quite good. He blocked me on Twitter once because I asked him a question or so. I don't even know why, but he's now saying that conditions are ripe for a repeat of the 1970s stagflation and the debt crisis of 2008. And I've always been saying that the problems that we had in 2008 weren't solved. The problems are still there. We haven't seen anything yet. We only saw the tip of the iceberg in 2008. But there is a whole ice block under the surface, and we're probably going to see this when the next crisis evolves. Warning signs are there for global economy, and central banks will be left in an impossible position, is what he says. And I completely agree, because what can they do right now? The same news for policies that are feeding asset bubbles will continue to drive consumer price inflation. We're seeing that the money that's creating right now from that total money that should enter the normal citizens, should enter the normal market, that money is like 5% ending up in mortgages or something like that. But for now, we're seeing that a lot of that money that's created is ending up in the stock market, ending up in the asset prices inflating. And that's not the way it should go, but they need to increase money because this deficit is so high, and also the GDP needs to grow still. And if there isn't more money created, then we're going to see that all these bubbles, for example, housing market, stock market, the bond market, are going to pop. And that's what these regulators from the central banks don't want at all. Making it worse, central banks effectively lost their independence because they have been given a little choice but to monetize massive fiscal deficits to forestall a debt crisis. So this is crisis on crisis on crisis, and then we end up in the 1970s, 1980s, where we had Paul Volcker. To be sure, real long-term borrowing costs may initially fall to if inflation rises unexpectedly, and central banks are still behind the curve. So central banks are definitely going to be too late if they can do anything about this. But over time, these costs will be pushed up by three factors. The first one is higher public and private debts will widen sovereign and private interest rate spread. The second, rising inflation and deepening uncertainty will drive inflation risk premia. And the third, rising misery index, the sum of inflation and unemployment rate, eventually will demand a Paul Volcker moment. And this is very important because in the 1970s, starting in the 1970s, then in the 1980s, Paul Volcker tackled the inflation. He managed to tackle inflation, and what he did was rising interest rates to at least 20%. And that was a tough time for America. And after this happened, the whole financial system was shaking. But he had to. Afterwards, the inflation started to decrease again. But there is one different thing, because there is now so much debt that if we manage to increase the rates, then a lot of consumers, a lot of countries, a lot of companies will have such big problems. They will probably default on their debt. So I don't know how Nouriel Roubini is seeing this. So two are the, let's say, where is it? Under these conditions, central banks will be damned if they do and damned if they don't. And many governments will be semi-insolvent and thus unable to bail out banks, corporations, and households. So Roubini is seeing exactly the same as I am seeing right now, because central banks can do nothing, and then everyone will be screaming, why are you doing nothing? But if they're doing something, then they will do something that's the worst. And the doom loop of sovereign and banks in the Eurozone after global financial crisis will be repeated worldwide, sucking in households, corporations, and shadow banks as well. As matters stand, this slow motion train wreck looks unavoidable. So he is saying there must something be done, but this is going to be really harsh. Or they're going to look from the sideline and do nothing, or they're going to look to step in, and this has, the results are the worst. So, okay, we have discussed what's going on with inflation right now and what we can see, what we might see in the future. But what does it say for the Dow Jones, for example, or gold and silver? So I found it interesting to take a look at what happened in the 1970s when inflation started. Inflation started around this point. Here we have the 1970s, and the stock market from this point, when inflation started, the stock market went from, let's say, 700 until 850. So it's not quite that fast. So if we take a look at 66 even, then the stock market went from 1970s to 1990s. So in like 17 years, it didn't increase in price. It went down, it went up, but it didn't went fast as we've seen like in 17 years after this whole scenario. So what did gold do? Gold went from, let's say, 37 or so to like 700. I don't even know what it did exactly. Yeah, to 700. And that's quite fast, because if we are entering an era in which we have inflation, then gold will be a hedge to inflation. So gold will be a good one to have in your portfolio. Stocks won't really, but they won't do worse than having, for example, having bonds or having normal like cash or so. So when it comes to this scenario, it's always good to see what the opportunities are. And in my honest opinion, when it comes to Bitcoin is showing hyperinflationary characteristics. And we're now in a market in which we're going down a bit. We have to calm down. But afterwards, the price will start moving again and it will show hyperinflationary characteristics, even though gold is still unhedged against inflation. And the stock market is doing so during this time. When it comes to the stagflation period, or when it comes to inflation, the stock market is usually going down a bit, and we're probably going to see that as well. Higher prices with a higher VIX, the VIX index, the volatilities index is not how things normally work. When it happens, it's a warning of trouble. So, for example, this is something like a negative divergence in the VIX index. The market can sometimes take a while before such warnings come around to finally matter, but they are worth paying attention to anyways. So he is saying, watch out, something is going to happen. And we have seen this earlier in this area. We've seen it around this area. This one was quite early though. this area as well, and we've had one over here, it didn't happen a lot, and now we're seeing this one again, but this one is a bit higher than usual, but still it's something to pay attention to when it comes to the stock market. So we're also going to take a look at central banks, and I've tweeted about this, and this was a tweet around the control of your money when it comes to central bank digital currency, because central banks know what is going on, and they know that they don't have a lot of options when it comes to inflation, when it comes to the interest rates, and they are looking for other ways to make sure that everyone around the world has still believes in the euro or the dollar, because this is the most important value when it comes to money. It's trust, and they want to show that they can be trusted. I want to show this video to you, and it's been deleted, I don't know why, but afterwards I will tell you what's going on.
Our analysis on CBDC, in particular for the use of general use, we tend to establish the equivalence with cash, and there is a huge difference there. For example, in cash, we don't know, for example, who's using a $100 bill today. We don't know who is using a 1,000 peso bill today. A key difference with the CBDC is that central bank will have absolute control on the rules and regulations that will determine the use of that expression of central bank liability, and also we will have the technology to enforce that. Those two issues are extremely important, and that makes a huge difference with respect to what cash is.
Okay, so what he's saying is the following. The central bank will have the absolute control on the rules and regulations that will determine the use of the central bank digital currency. So what he's saying right now is actually quite crazy and quite scary at the same time, because he's saying we're going to control the money, we're going to control all of the rules, all the regulations, and we want to know where you put your money in. For example, in the beginning, he says, right now with the peso bill, with the dollar bill, we don't know where you're spending your money. And with the central bank digital currency, we do know. But afterwards, there has been so much discussion about this guy from the BIS, the Bank for International Settlements, that this tweet probably has been deleted. And I wanted to tell you, if they control your money, they can control you. And this is a really important one, because if you are entering this central bank digital currency system, they can tell you that you can't go to the supermarket anymore because you haven't went to the gym. Or they can tell you that you can't invest in Bitcoin anymore because it's not good for the environment or something like that. So keep in mind that you always want to have control of your own money, of your own value, your total portfolio. So keep this in mind, because it's quite scary. And then at the same time, Jerome Powell said that cryptocurrencies completely failed to become a payment mechanism. And to be honest, I want to recommend something, by the way, because I've recently downloaded the Blue Wallet app, and it's great. If you want to have a great Lightning, this is not like sponsored or something like that, but if you want to have a great Lightning wallet, then just use the Blue Wallet. It's so easy. It's almost free to do transactions for buying coffee or something like that, and it's as easy as using Apple Pay. So, in my honest opinion, when it comes to central bank digital currencies, or I must say, when it comes to cryptocurrencies, they haven't failed yet. They are just in the beginning. They're just in the begin phase. And Jerome Powell probably didn't use his Visa card with cryptocurrency, or he didn't use the Blue Wallet or something like that. So keep this in mind when it comes to these old regulators, these old central bankers saying something about cryptocurrencies. But at the same time, Steven Mnuchin said something interesting as well. If people want to buy Bitcoin as a substitute, there's no difference than buying gold or some other assets, and that is fine. I don't personally want to have it in my portfolio, but if people want to, that's perfectly fine, says Steven Mnuchin. And that he was the former Treasury Secretary, and that's quite interesting. So he has turned 180 degrees when it comes to his vision on Bitcoin, and he says it's fine, it's just an asset. We see it as an asset. Then we had some news from Jack, and I've been to Miami, the Bitcoin 2021 conference, and Jack had a rough time there. He was on stage and people were shouting at him, and that was because he is the CEO of Twitter and he's the CEO of Square as well. And he said there's nothing more important in the world to work on than Bitcoin, but with my two companies I can make a difference when it comes to Bitcoin, otherwise I'd be working on Bitcoin. And people were shouting at him. And afterwards he tweeted, "I get it, thanks, I get it." And what he did was starting a new business. Of course, he is doing something with his hardware wallet. He's going to make it completely open source, and it's completely open for everyone to build. And he's creating a new business with Square and joining Stellar, the Cash App, and Tidal, focusing on building an open developer platform with the sole goal of making it easy to create non-custodial, permissionlessness, and decentralized financial services. Our primary focus is Bitcoin. Its name is TBD. So he is starting to go more into the permissionlessness and the decentralized financial services. And I think this is a good way to get back on track after what happened with Twitter and all the censorship as well. And a lot of people have been asking, is this the end of the bull market? Is the bull market over? And in my honest opinion, there's something going on that's really interesting. The top Bitcoin whale addresses continue holding at largest supply levels of BTC since April 2019. So what we are seeing right now is that the biggest addresses, the addresses holding 100,000 BTC to up to 1 million BTC, have been increasing since January 2021 and are still increasing, or at least until the 8th of June we're still increasing. As you can see in this picture, these yellow line are the addresses with having 100,000 plus BTC, and they've increased from, let's say, 1.1% until 3.6%, and the addresses holding 10 until 100k BTC went down quite a bit, but it isn't that fast. They went down from like 13 to like 11%. So we are going to keep an eye on the on-chain metrics for the coming weeks and months, because I think these are kind of interesting when it comes to fundamental analysis on Bitcoin. And we're also taking a look at the stock to flow model. The stock to flow is quite interesting. It looks like 2013, but also completely not when it comes to the blow off top. We haven't seen a blow off top over here. It was just like a really sharp move downward, but we can still make a bow over here. And when we are taking a look at the technical aspect when it comes to Bitcoin, we're seeing a lot of different things. On the 4-hour chart, I'm using the Bitstamp chart, Heikin-Ashi candles, and this is an RSI. Right now, we are seeing, by the way, something interesting going on, but I will mention it later on. Okay, what has happened here? The price of Bitcoin went down in this downward trend. Then we had this trend, which was a bit less downward moving, and we broke out upward, but the volume was way too low for confirmation. And afterward, we went down back into this downward movement, and now we're seeing this falling wedge. And when a falling wedge happens, usually the breakout happens to be upward in 67 or 63% of the cases. So what does it look like? It looks like this. This is the falling wedge coming from above, going like this, upward, testing the older resistance that's becoming a new support line, and then going out upward. So we are seeing this movement going downward again, and then upward, first testing by the way, and then we're going upward again, and that will grow a bull or something like that. But to be honest, the chart is looking very boring. Usually when it comes to this chart pattern, the volume has to go down, and the volume is really low, has been really low over the last couple of days, over the last couple of weeks as well. The only thing that isn't really like giving me this feeling is that we haven't seen this line. So there hasn't been in the normal, like, it was way better if we'd seen this movement like this, but we haven't seen this movement. But still, it's almost looking like this pattern, but we're still doubting a bit. So if we break out downward this area, and we hit on the 4-hour chart, we hit the body closing like below, let's say 929, then we have a big problem, because then there is a big chance that we will see new lows, and that will be the end of the bull market in my honest opinion. But for now it doesn't look like that, because we can still manage to break out upward. If we break out upward, then we're going to see a new price target of 40k, so it can happen quite fast. But for now we're still waiting. Everyone is waiting, all the traders are waiting as well. And I found this tweet: oh shit, Bitcoin is dying. It was 10k 10 months ago, and now it's only 31.7k. So I want to show you that price changes can happen really fast, and this doesn't mean that Bitcoin is dying. This means that the bottom is going higher. As we've always seen when it comes to Bitcoin, bottoms are going higher and higher and higher. So keep that in mind when panicking. We have just been in this midterm bear market for like 3 months or so. So it's completely fine. We've had bear markets for over 1.5 years, and that's not even strange. I mean, we've just watched this scenario, and then the market went down for like 17 years or so, or at least sideways for 17 years. So that's completely boring. I mean, here we had a year of bear market from January 73 until January 75. So it can be way worse. And keep in mind the complete economic story I've just told you with the inflation in perspective. And to me, Bitcoin is a hyperinflationary hedge. Gold is an inflation hedge. And this is just, to me, it's just so important to make sure that your portfolio, the assets in your portfolio, are diversified in different boxes, to make sure that you are safe during every period of these economic cycles. This was Madelon Talks for this week. I hope you've enjoyed this video. Make sure to press the blue thumb if you like this one. And also make sure to follow me on Instagram and Twitter so you get notified when there is news with the latest news. And for now, I'd like to thank you for watching. See you next week when it comes to the new Madelon Talks. Bye!